Joining us right now for more on the economy is John Ryding, Brean Capital Chief Economic Advisor. And John, let's quickly look at these numbers that just came through. You said it's the jobless claims. It's really the big wow here.
Right. It is, because we had a little bit of a surge on the effects of hurricanes Helene and Milton. Mm-hmm. The numbers have not only gone back down, we're now at the lowest level on initial jobless claims since April. It's at the same level as a year ago. So what does that say? It says companies are not firing people at a faster rate. The layoffs have to be remaining, for the economy as a whole, relatively low here. And so, that's something that the Fed certainly needs to take into consideration when it thinks about the pace of rate cuts.
And yet you still have consumers that are a little hesitant. We heard from Target this week. Walmart had better numbers, but Walmart's also dealing in far fewer discretionary goods than Target is. You hear from anybody who's watching the retailers at this point, and there is some concern that there's some hesitancy and consumers that are focused on budgets.
I think there is, and there's signs that consumers are stretched in some parts of the income distribution. There's also signs, though, that consumers are better off than we thought, because when we got those revisions to the GDP data a month or so ago, we found that the savings rate was significantly higher over the last year than previously thought. So people have been saving more. So they have, in a sense, a little more, maybe dry powder is the wrong word, but they're in a little less need to have to pare back to sustain their finances.
So if we were to bet on Christmas this year, what would that bet? I mean, we got Target up there on the screen right now. What would you bet if we looked at retail, just overall? If you came in on January 5th, what would we say?
Well, it's really hard to say, Andrew, because economists live in a seasonally adjusted world. So it's like 1/365th of Christmas every day. But, I mean, if you look around the city, you look outside the studio here, you look coming down Fifth Avenue, things look pretty busy out there. So I don't know how Christmas is going to be. I don't know for any particular retailer, but there is no sign, in my opinion, that the consumers are getting ready to retrench here.
Back to this idea of what the Fed should be doing, because that's the important one for the markets. We keep looking at this as a Goldilocks time where the economy's pretty good, earnings are still coming in strong. And yet you've got the Fed cutting rates. Do you think the Fed is going to pull back and cut less than the market is expecting at this point?
They're going to have to. Well, the market's already expecting the Fed's going to cut less than they said back in September they were going to be cutting. September was really odd. The Fed panicked, in my opinion. Cutting rates by 0.5 point. We saw no justification for that. Yes, policy was tight. Yes, they could plan to cut rates a little bit gradually and get back to neutral. But they panicked because they were worried that the economy was in rougher shape, that the unemployment rate might be going significantly higher. And since that Fed meeting in September, and they've cut again since then, we've had, with the exception of the hurricane effects of October, a stronger jobs report. We've had upward revisions to GDP, so we know the economy is growing faster than 3% over the last year, and the current quarter looks like it's very early days, but might be on track to something pretty close to 3%. So the economy's been strong. We know inflation has been a little higher than the Fed has been expecting. So the Fed
stock market,
really
Bitcoin. We had stock market, Bitcoin. I mean, there's no reason. You have not said that they were right about the 50 basis point.
Right. Well, they were not right. But the Fed just doesn't like to admit to mistakes. Mm-hmm. And the cut in the last meeting in November, I think, was like almost, you can't say they doubled down because they cut by a quarter, right? Doubling down would be cutting by half. But it was almost like saying, we did make a mistake. In fact, we're willing to do a bit more. But they have to reevaluate what the outlook for rates is. And in particular, and we had John Williams speaking, the New York Fed president, this morning. In particular, they have to really rethink about where is the neutral level of interest rates. They're saying, adjusted for inflation in September, it's 0.9%. In the market, it's above 2%. The market has got a 10-year inflation-adjusted yield of above 2%. And the Fed really needs to stop guiding people to a destination that they don't know is the right number, and the market evidence suggests that it's the wrong number.